accounting. Let us begin with some basic understanding on accounting and its application in the common world. We shall be discussing concepts like need of accounting for business, revenue and expenses, basic accounting principles, concepts and assumption. Let us start with the question, what is accounting? Accounting is a system which collects and processes financial information of a business. It is called the language of business. This information is reported to the users to enable them to make appropriate decisions. This need of recording business transactions in a systematic manner has given rise to bookkeeping. All transactions related to business and expressed in monetary terms are recorded. The accounting process starts with the business transactions, then moves on to identifying, recording, classifying, summarizing, analyzing, interpreting, communicating in monetary terms, through financial statements, and finally it is passed on the users. Now we have an idea about what is accounting theoretically. Let us understand its application. The accounting cycle, which is an end-to-end sequence of the accounting process, begins with the recording of transactions and ends with the preparation of final accounts. When a company starts its activities, day-to-day transactions are recorded in the journal. Transactions from the journal are moved to ledgers where the accounts are written. The ledger has combined effect of debit and credit pertaining to each account in the form of balances. These balances are then transferred to a statement called trial balance to prove the accuracy of the work done. The preparation of trading and profit and loss account is the next step. P&L account gives the net result of the business transactions. Balance sheet is prepared at the end to know financial position of the business. The last year's figures are carried forward as the opening balances for the next year. Now it is time to explain the term, double entry system of accounting. For ages, accountants have been using an accounting procedure termed as double entry system of accounting for recording transactions. In double entry system, each amount is recorded in at least two accounts. Recording of transactions can be done by two approaches. One is accounting equation approach, the other one is traditional approach. Accounting equation approach is also called American approach, wherein transactions are recorded based on accounting equation. Whereas traditional approach is called British approach, wherein transactions are recorded on the basis of existence of two aspects in each transaction, that is debit and credit. We have learnt about double entry system of accounting, where we ended up with list of accounts. We shall now look at the classification of those accounts. As per double entry system, the transaction amount is entered on left side of one account and on the right side of another account. Account is a summary of relevant transactions relating to a particular head. Accounts may be classified based on kind of transactions. Transactions can be divided into three categories. Transactions relating to individuals and firms, transactions relating to properties, goods or cash, and transactions relating to expenses or losses and incomes or gains. Therefore, accounts may be classified as personal accounts, impersonal accounts. Impersonal accounts are further classified into real accounts and nominal accounts. Business transactions are recorded on the basis of the following golden rules of accounting. For personal accounts, debit the receiver and credit the giver. For real accounts, debit what comes in and credit what goes out, and for nominal accounts, debit all expenses and losses and credit all income and gains. Now, let us discuss on journals and ledgers. Journaling is the process of making entries in the accounting books by following the double entry system. The accounting books in which transaction is recorded for first time from any of above source documents is known as books of prime entry or journal, because journal is one such book where business transactions are recorded in chronological order by following double entry system. Whereas ledger is the principal book containing all the accounts. This is also called book of final entry or book of secondary entry, because transactions are recorded here finally. Benefits of ledgers are: ledger gives snapshot of an account, all at one place. For example, all cash transactions at one place. trial balance can be prepared to check arithmetical accuracy of the accounts in ledger. It facilitates preparation of final accounts for ascertaining operating result and financial position of the firm. Let us now understand accounting assumptions, which are the pillars to accounting results of the company. Business is an entity separate from the owners or creditors. By this logic, owner's capital is credit to the company. This is accounting entity assumption. Only financial transactions and events get recorded in accounting. This is money measurement assumption. Users of the financial reports are interested in periodical reports because they want to know financial position for certain period by certain date. This is accounting period principle. Business shall go on without winding it up in foreseeable future is the assumption while recording transaction. This is going concern assumption. In accounting, there are certain concepts which guide recording of business transactions. Assumptions given above have given rise to following concepts. All business transactions are recorded in two aspects. When business acquires asset, it is receiving benefit, but it must pay, which is giving benefit. This is called dual aspect principle, which is the basis for double entry system of bookkeeping. Any revenue is recognized as income earned on a date only when it is realized. This is revenue realization, recognition, concept. Unrealized revenue should not be considered, as it may inflate income and hence profits. All the assets are recorded at their acquisition price, and further accounting treatment is based on this cost. This is historical cost concept. All revenues earned are matched with expenses, cost, during a given accounting period to come to the final financial position. This is known as the matching concept. This concept helps in determining accurate profits for the given period. Various interested parties expect full and complete disclosure so that they can make rational decision. This is full disclosure concept. For each business transaction, the books of accounts should have adequate evidence to support it and should be free from any bias. This is verifiable and objective evidence concept. As we have discussed the principles and concepts, we shall now discuss their modification using modifying principles. The cost of applying principle should not be more than the benefit derived from it. If cost is more than benefit, then that accounting principle may be modified. This is cost-benefit principle. All relevant information should be disclosed in the financial statement. Insignificant and immaterial information should be left out. This is materiality principle. The rules, practices, concepts, and principles used in accounting by a firm should be applied year after year consistently to ensure comparability of financial statements. This is consistency principle. Consider all prospective losses but leave all prospective profits. This is prudence principle. The essence is anticipate no profit and provide for all possible losses. As of now, we have looked into the basics and fundamentals of accounting. Now, Let us dive into ascertaining the financial position of a company through final accounts. A businessman is interested in knowing whether the business has resulted in profit or loss and what the financial position of the business is at a given period. This can be ascertained by preparing the final accounts. The final accounts are prepared at the end of the year from the trial balance. Hence, the trial balance is said to be the connecting link between the ledger accounts and the final accounts. The final accounts generally include two statements known as balance sheet and income statement, which is required for external reporting and also for internal needs of the management like planning, decision-making and control. The profit and loss account is the accounting report which summarizes the revenues and expenses and ascertains the profit or loss for a specified accounting period. The purpose of the balance sheet is to showcase the resources and obligations, that is, assets and liabilities. Balance sheet is the statement prepared on a particular date and shows classified properties and assets on the right-hand side and obligations or liabilities on the left-hand side. Let's look into the financial statements in detail. An income statement will show how profitable the company has been during the time interval shown in the statement. For example, FY 2008 to 2009. This period of time might be monthly, quarterly, or yearly. While reporting profitability, two things are considered. One is revenues, which is the amount earned, and second is expenses, which means the amount spent to earn revenues. The two terms revenue and expenses are broad terms which we shall explore in the next slide. The company should record revenues when they are earned under accrual basis of accounting, and not when company receives the money, which is generally done under cash method of accounting. Recording revenues when they are earned is the result of one of the basic accounting principles known as the revenue recognition principle. Let us try and understand this concept with an illustration. Suppose you sell 1,000 pizzas in July for Rs 100 per pizza, you have earned Rs 1 lakh for that month. You ask consumers to pay by August 5th as per payment terms. Even if customers did not pay by August 5th, accrual basis of accounting require that Rs 100,000 be recorded as July revenue because pizzas were sold in that month. When you match revenue with expenses, the company's income statement shows how profitable it was in July. When you receive Rs 100,000 on August 5th, you will have to make an accounting entry to show the money was received. This receipt will not be considered to be August revenues, since the sales were already reported as revenues in July when they were earned. Rs 1 lakh will be recorded in July as a reduction in accounts receivable because in July you had made an entry to accounts receivable and to sales. After understanding about revenue, let's turn our attention to another part of income statement, expenses. The income statement for July should show expenses incurred in July regardless of when the actual payment happened. This recording of expenses with the related revenues is based on basic accounting principle known as the matching principle. Interest expense is a cost necessary to earn revenue. We have made things easy here. In reality, there are many complexities to the income statement. The difference between revenue and expenses is often referred to as the bottom line and labeled as net income or net loss. Now let us discuss on another kind of financial statement. The balance sheet reports a company's assets, liabilities, and stockholders, or owners, equity at a specific point in time. It is a snapshot of a company's financial position at a given moment. For example, if a balance sheet is dated March 31, 2009, the figures shown on the balance sheet are the balances in the respective accounts after all transactions of March 31, 2009 have been recorded. We shall discuss about them in detail now. Assets are the resources that a company owns. So all motor vehicles, real estate, cash in the bank, security investment and other holdings are assets. These assets can be reported in their respective account heads. Accounts receivable is also one asset as it records earning or sale made but not paid. A company's assets are recorded at original cost and are carried forward at the original cost, even when market value of the item has increased. This is due to another basic accounting principle known as the cost principle. By cost principle we mean that the assets cannot be reported at more than the cost at which they were acquired. All assets such as equipments, vehicles, and buildings are routinely depreciated. This is as per the matching principle. For the sake of definition, depreciation is allocation of cost of the asset to depreciation expenses in the income statement over its useful life. Generally, depreciation is used for assets whose life is limited. Thus, the value of asset on the balance sheet might have appreciated in the market, but it is consistently reduced in the balance sheet as the accountant will allocate some of its cost to depreciation expenses in the income statement. It is also possible that some asset, for example furniture, might have a lesser fair market value than the book value reported on balance sheet. Land is not depreciated, hence it appears at its original cost. Current asset or short-term asset values are close to their market values, since they tend to turn over in short periods of time. The balance sheet also showcases the liabilities of the business as on date of reporting. Liabilities are obligations of the company to others, such that loans from lenders, the interest on the loan, the amount payable to others, generally known as accounts payable. Occasionally companies also receive money in advance before actually earning it, and also sometimes are liable to pay expenses which are accrued but not yet paid. These are also categorized as liabilities. Another section in the balance sheet is stockholders' equity. It is also called owner's equity, if company is a sole proprietorship firm. The stockholders' equity is the difference between the asset and liability. It is book value of the company. It comprises of common stock, preferred stock, retained earnings, and current year's net income. Whenever a company issues shares, the common stock increases. With the increase in profit, retained earnings increase, and exactly the opposite happens when a company incurs a loss. This implies increase in revenue increases stockholders' equity, and expenses cause decrease in the equity. In the preceding session we learned that an account is a record of all business transactions relating to a particular person or asset or liability or expense or income. This record is maintained in an account. As per accounting equation, approach rules for debit and credit depend on the nature of an account. Account may be classified as follows: assets accounts, liabilities accounts, capital account, incomes, revenues, accounts, expenses, losses, accounts. Whenever there is an increase or decrease in one account, there will be a corresponding decrease or increase in another account. The table will explain this in detail. Let us discuss another financial statement, the statement of cash flows. This statement shows how cash has changed during the time interval for which it is made. It shows the cash generated and used by your company's operating activities, investing activities, and financing activities. Much of the information in this statement comes from the balance sheet and the income statement. Operating activities. It converts the items reported on the income statement from the accrual basis of accounting to cash. It shows the results of cash inflows and outflows related to the fundamental operations of the basic line of business in which the company is engaged in. Cash receipt from the sale of goods and cash outflows for purchasing inventory and paying rent and taxes. Investing activities. It reports the purchase and sale of long-term investments and property, etc. Financing activities. It reports the issuance and redemption of shares and the payment of the dividends. There are certain adjusting entries which need to be considered while preparing the final accounts of a company. Adjusting entries are journal entries made at the end of the accounting period to allocate revenue and expenses to the period in which they actually are applicable. Hence, many items need some adjustment while preparing the financial statements. Adjusting entries almost always involve a balance sheet account and an income statement account. Some important and common items, which need to be adjusted at the time of preparing final accounts, are as below. Outstanding expenses are expenses accrued but not yet paid. Prepaid expenses are expenses paid but not yet accrued. Accrued incomes are incomes pertaining to this period, but not yet received. Incomes received in advance are income for future period received now. Accrued interest on loan is the loan interest not paid which has been accrued during the financial period. Dividend payout is the excess of distributions over the loan to beneficiary. Accounts receivables or payables. Once the accounts are finalized, they are not closed at the end of the accounting year. Their balances are automatically carried forward to the next accounting year. In case of revenue and expense accounts, the balances are cleared to income or expense summary account. The net amount is then moved to retained earnings, which is the part of total capital contributed. To promote worldwide uniformity in published accounts, the International Accounting Standards Committee, IASC, was set up in 1973 to formulate and publish standards which are popularly known as International Accounting Standards, to be observed in presentation of financial statements for worldwide uniformity. This committee minimizes differences in accounting practices across countries. IASC became IASB, B for Board, in 2003. Since then, the IASB has amended some IASs and replaced some IASs with new International Financial Reporting Standards, IFRSs, and proposed certain new IFRSs on topics for which there was no previous IAS. In our country, the Institute of Chartered Accountants of India, ICAI, has constituted Accounting Standard Board, ASB, in 1977. The ASB has been empowered to formulate and issue accounting standards.